Hey, I want to let you know that Carl White and the Marketing Animals have a comprehensive list of 180 things a realtor does, or rather a realtor should do. If you'd like to get this and share it with your realtor partners, which might be a good idea, it's free of charge. It's a download. All you have to do is click this banner right down below. So in a recent study conducted by 4 professors about the United States banking system, they concluded that the U.S. banking system's market value of assets is $2 trillion lower than suggested by their book value of assets, accounting for loan portfolios held to maturity. Market-to-market bank assets have declined by an average of 10% across all the banks, with the bottom 5th percentile experiencing a decline of 20%. And as a result, 186 banks are in jeopardy of suffering a similar fate as Silicon Valley Bank. Now, just a couple of days ago, we've told you that we've truly only had 2 bank failures this year. But if this new hypothesis comes true, 2023 will make 2008 look tame. Now, the question is, in our world, is that necessarily a bad thing?
Because the study that concluded this is talking about depository banks. We occupy the non-bank segment of the banking community, but make no bones about it, these institutions write loans. So if they fail at a catastrophic rate, they would probably be absorbed by the big 4, Chase, Wells, Citi, B of A, and guess what they don't do? Write loans. Meaning your competition just got much thinner.
It's kind of like, imagine if there are only 9 teams in the NFL. Now, if that was the case, if my Niners were one of those 9 teams, they'd have like 20 Super Bowls by now. So think of these bank failures as a culling of the herds of your competition that you might actually benefit from.
As it stands, the Fed is trying to keep these smaller banks open and independent. They've done this by lending out over $300 billion in the past week to cash-strapped banks. I mean, Credit Suisse takes a $50 billion bailout and we go, whoa. Then we come in and say, oh yeah, hold my beer.
$300 billion. So nearly half of that money, $143 billion, went to holding companies for 2 major banks that failed over the past week. That'd be the Silicon Valley Bank and Signature Bank, triggering widespread alarm in the financial markets. The Fed did not identify the banks that received the other half of the funding or said how many of them did so.
The rest of the money was borrowed by banks seeking to raise cash, likely at least in part to pay off depositors who tried to withdraw their money. Many mega banks, such as Bank of America, have reported receiving inflows of funds from smaller banks since the bank failures last weekend.
$300 billion. Is this a here we go again moment? Didn't we just learn that putting billions or trillions of dollars into the economy triggers inflation? You see, the Fed has been aggressively trying to lower its balance sheet. That's the reason mortgage interest rates are so high, through the Fed's selling off of and lowering purchases of mortgage-backed securities. It's not the Fed fund rate, it's the Fed balance sheet. So now the government wants to come in and save every banking institution from failing? I mean, I say let them go the road of Merrill Lynch and push daisies, because the alternative of putting all this money back into the economy is going to trigger inflation and just make the misery that we're in last longer.